Hello again, this is Mark with Semantics Research with part 3 of the valuation series. So in this section, we will go briefly over some basics in the income statement for those who are not familiar. And this includes revenue, cost of goods sold, gross profit, and operating expenses. The first line in the income statement is total or gross revenue, which is the amount of money that flows into a company during a certain time period. The reported income statement is either a quarterly or yearly statement. For example, if Nike sold $100 million worth of sneakers in a year, the total revenue for the year is $100 million on the income statement. However, just because a company makes a lot of revenue does not translate to profitability. To see if a company is profitable, you would have to look at the total revenue minus expenses, which is the net earnings. The revenue number is meaningless because unless we see the net earnings, we don't really know much about the company. Now, another one is the cost of goods. The cost of goods sold, or also known as the cost of revenue. And that is the cost of the purchasing goods, materials, or the cost of labor in manufacturing. And if the company provides a service, you will generally see the cost of revenue instead of goods. So for example, if the cost of goods for a hardware store can be calculated by starting with the cost of the products in inventory at the beginning of the year, and then you add the cost of adding more inventory throughout the year, and then you subtract the leftover inventory at the end of the year. So for example, if the company has 10 million in inventory and makes 2 million in purchases to add inventory and ends the period with an inventory worth 7 million, then the cost of goods would be 5 million. Although it does not go deep into a company's context, it tells us the gross profit of the business, which is crucial. Now, going into gross profit, it is essentially how much money the company has made off of the total revenue after subtracting the costs of the raw goods and labor used to make the goods. It does not include sales and administrative costs, depreciation or interest costs. Gross profit does not tell us much, but we can use it to calculate the gross profit margin, which tells us the economics of the company. Companies with a competitive advantage will consistently have higher gross profit margins than those that don't. Having a competitive advantage is what allows companies to have higher profit margins and set the price of products and services it sells. So that's pricing power. If the company did not have a competitive advantage, then they will have to compete with other firms by lowering prices of their products and services. And generally, we look for companies with 40% profit margins or better, but it varies from sector to sector. Under 40% profit margins means that the firm is in a competitive sector and competition is hurting profit margins. Now, under 20% profit margins means that the company does not have a sustainable competitive advantage over the competition, and its fate is quite grave, rather. And while profit margins do have some importance, it is not a tell-all of the company. Now, this is a formula for the gross profit margin. So you get the revenue minus the cost of goods sold, and then you divide it by the revenue, and that gives you the profit margin. So essentially, this gives you a percentage of the profit margin. Now, briefly touching upon operating expenses, it is a company's hard costs with running the business and includes selling, general administration, research and development, depreciation and amortization, restructuring, and impairment charges. We will go further into detail on each of these in future videos. But anyways, with those added up, they make up a company's total operating expenses, which are then subtracted from the gross profit to give us the firm's operating profit or loss. And that is it for part 3 of the valuation series. I want to thank you all for watching.